Hello everyone, welcome back to another video. In this video today, you will practice a question which involves accrued expenses and income received in advance. You will see the question on the left hand side of your screen, and on the right hand side, we will do all the workings step by step. With that being said, let's begin. Angela prepares her year-end accounts at the end of the financial year 31 December 2016. The following account balances were provided on 1 January 2016. So based on the first paragraph, we understand that we are working with a business which has a financial year starting on 1 Jan 2016 and ending on 31 December 2016. So these are the opening balances for three different accounts on 1 Jan 2016, which are bank loan, accrued interest expense, and rent income received in advance. We are given some additional information here with regards to the loan and the interest payments. We are also given other information for the annual rental income. The requirement of the question is to prepare the ledger accounts for interest expense and rent income. So we will start with the interest expense ledger account, but for that to happen, we need to first do some workings. All right, so we want to calculate the interest expense first. And because we know that interest is paid every year on 30th of June, and given that our financial year starts on 1 Jan, we can only calculate the interest from 1 Jan to 30 June to begin with. So we want to first find out the interest expense from 1 January 2016 until the end of 30 June 2016. And how do we do it? We use the given rate of 5%, which is the annual rate, which is valid for the entire year or 12 months. And then we multiply it with the loan amount of $100,000. And then we further multiply it with 0.5. The reason we're multiplying here with 0.5 is because we know the 5% rate is for the entire year. So when we multiply with 0.5, this converts the 5% rate into a 6-month rate, which gives us the interest expense from 1 Jan 2016 until 30 June 2016. Okay, so on that basis, the interest expense for the first 6 months, based on our calculations, is $2,500. Now, we also know, based on the additional information that is given to us, both the repayment of the loan and the 5% interest are to be paid every 30 June. Okay, so what that means is we know that there is a loan repayment on 30 June 2016, halfway during the year, and that amount is going to be $10,000, given that $100,000 was the original amount, and that is paid in equal amounts over 10 years. That's based on the additional information which we are given, which you can see I'm circling. It mentions that the loan is repayable over 10 years. So if the loan amount is $100,000, then every year we can pay off $10,000, okay? So $10,000 is the loan repayment on 30 June. Now we want to find out the interest expense for the remaining 6 months in the year, which starts on 1 July 2016 and ends on 31 December 2016, okay? And how do we find it? We use the annual rate of 5%, multiply it with the remaining loan amount. It's not $100,000 like the first 6 months. It's now $90,000, because we know we had just made a repayment on 30 June of $10,000. Therefore, if you want to calculate the interest expense for the remaining 6 months, that $10,000 needs to be deducted from the $100,000. Make sense? And then we multiply it with 0.5, because the 5% is an annualized rate. And when we multiply with 0.5, we're converting this into a 6-month rate, okay? And that gives us an interest expense for the remaining 6 months, starting 1 July 2016 and ending 31 December 2016, and the amount is $2,250. So altogether, the total interest expense, which you will report in the income statement or the profit and loss statement or the statement of financial performance, is $2,500 for the first 6 months, plus an additional $2,250 for the remaining 6 months, which gives us $4,750. Okay, all right. Now let's look into the preparation for the interest expense ledger account. So I have already created the outline here, which is the 5-column format. In the first column, we've got the date. Then in the second column, we've got the details, where we are going to cross-reference all the relevant accounts. In the third column, we've got all the debit amounts. In the fourth column, we've got all the credit amounts. And in the fifth column, we've got the net balance. Okay? So we are starting our ledger account with the transaction from 1st of January 2016, which refers to the opening balance. The opening balance that we are given on 1 Jan 2016 is for accrued interest expense, right? So accrued interest expense of $2,500. When we think of accrued interest expense, this is referring to interest expense that we have incurred in the previous financial year, but we still haven't made the payment using cash or our funds in the bank account. Therefore, this is a present obligation for us, and this falls within the definition of a current liability. We know all liabilities by default are credit, which means when they increase, we credit them. When they decrease, we debit them. This also means that all liabilities should have an opening balance on the credit side. Okay, so 1 January 2016 refers to the opening balance because it's at the very beginning of the financial year, and that balance of 2,500 it will be reported on the credit column. So what we're going to do here on 1 Jan 2016 is we will write accrued interest expense. Okay, I'm just writing accrued int exp in short, but you have to write the full word during the exam. So accrued interest expense, being a current liability, has an opening balance on the credit side, which gives us a net balance of 2,500 credit for 1 Jan 2016. Okay. Now, during the year, let's look into additional information number 2. Additional information number 2 says that on 30 June 2016, a check of $18,000 was paid to the bank, of which $10,000 is for the repayment of the loan. We have already derived this amount by using $100,000 divided by 10 years, given that we're repaying the loan in equal amounts every year, right? And which also makes complete sense based on what they have told us. And the remaining is for the payment of interest. So if $18,000 is the total amount we have used, and out of that $10,000 went towards the repayment of the loan, the remaining should be $8,000, which is paid for interest expenses. Okay. Now, when we are making a payment for interest, what is the journal entry? Debit interest expense and credit the cash at bank. Now, why is the cash at bank being credited? Because the question explicitly mentions the word check, and cash at bank is credited because assets are going down. Our funds available in the bank account are going down. So when assets go down, we credit it. So that's why we're crediting cash at bank. Okay. So if we are crediting cash at bank, the relevant cross reference for the other account is to debit interest expense. Okay. So in the interest expense account itself, we have to show this $8,000 within the debit column, and the cross reference here is the cash at bank. Okay. And this is based on the explanation for the journal entry, which we have just discussed. Now, what is the net balance that we should write here? Now, previously, at the end of 1 Jan, we had a balance of 2,500 credit. Now we have 8,000 debit. So the final balance is going to be 5,500 debit. How did we find it? We found the difference between 8,000 and 2,500, which is 5,500. And obviously we have more debits than credits, so therefore the weight remains within the debit. So that's why the balance is 5,500 debit. Okay. All right. Then what happened on 31 December? So on 31 December, we have to show the amount, which is the total interest expense of 4,750 that we're going to report in the profit and loss statement or the income statement. Okay. So that amount which is 4,750, is recorded on the credit column for the interest expense account. And what is the logic? Always remember that all expense and income accounts are temporary in nature, which means at the end of the financial year, both income and expense accounts must have a final balance of 0 before we start the next accounting period. And this is mainly dependent on the matching or the accrual accounting concepts, which requires the expenses incurred and the revenues earned to be used in the calculation of correct profits. Okay. Now, when we want to transfer all the amounts that we have got in our expense accounts into the profit and loss or the income statement, we have to reduce what's remaining in the expense account. Expenses by default are always debited when they increase. Now, if we have to transfer these amounts out of the expense accounts, we have to credit it, right? So that is why within the interest expense account, we're recording this 4,750 on the credit side, with the cross-reference being the profit and loss account, okay? So what's remaining afterwards is 5,500 debit, take away or subtract 4,750, we're left with 750 debit, okay? Now, again, we just had that discussion a while ago where all expense accounts must have a closing balance of 0. So we already know the closing balance here should be 0. How can we make it 0? We need to have a number here on the credit side, which is going to be 750, because 750 credit can offset the 750 debit from the previous transaction, right? Now, what is this 750 credit? Okay, I want to show you something here. So let me draw a table again, which you may have seen in my other videos. So we know we have got assets and we have got liabilities, okay? And both these have opening and closing balances. All assets should have an opening balance on the debit side and a closing balance on the credit side. All liabilities should have an opening balance on the credit side and a closing balance on the debit side, okay? Now, this amount that we have got here is for 750, it's on the credit side. And this is at the end of the financial year on 31 December 2016. How do we know it's at the end of the financial year? Because we have already taken care of all the relevant information that we could utilize from the question. If you have a quick scan through, you would see we have used all the information relevant for interest expense. And we also know for sure that the final amount is going to be 0 based on the fact that all income and expense accounts must be reset to 0 balances at the end of the financial year. And this is mainly because of the matching or the accrual accounting concept, which requires us to calculate profit correctly based on the revenues that we have earned and the expenses incurred for that specific financial period. Now, once we have established all these rules and fundamentals, and given that we know that assets and liabilities will have a closing balance on the credit side and debit side respectively, what is the narrative or the account that we can cross-reference here? So this is 750 reported on the credit side. Only an asset can have a closing balance on the credit side. Isn't that so? Okay, so if that is the case, and it's an asset, is it not therefore a prepaid interest expense at the end of the financial year? Prepaid interest expense refers to payment for interest that you have made in advance, and this payment refers to the next financial year starting 1 Jan 2017. And at 31 December 2016, this $750 is not relevant for this period, but it's relevant for the next financial period. So therefore, this falls within the definition or category of a current asset, all right? So therefore, that 31 December 2016, we have our final narration, which is for prepaid interest expense, 750 reported on the credit side, which ends up giving us a net balance of 0 at the end of the financial year, okay? Now we will prepare the rent income account. Now, I have already prepared the outline here, and I'm going to do it with you. So let's see what's going on. First of all, we'll start with the opening balance that we are given at 1 January 2016. And we are given the balance for rent income received in advance. Isn't that so? Rent income received in advance. So rent income received in advance basically means that you have got the money from your tenant, but your tenant still hasn't used that space yet at 1 Jan 2016, which means this is a current liability for you because you have a present obligation as a business to fulfill this for your tenant. You have taken the money from your tenant, but you haven't earned it. You have just got the money in advance and your tenant still has to use the space, okay? So because this is a liability, and based on the table which we have prepared earlier, we understand all liabilities should have an opening balance on the credit side. So what we're going to do here is include the amount for rent income received in advance of 2,300 on the credit column, okay? So rent income received in advance, which leaves us with the net balance at the end of 2,300 credit, okay? All right, so we have no information relevant to rent income in the first and the second additional information, but in the third one, we do. In the third information, it's mentioned that annual rent income was $14,000 and checks received during the year for rent amounted to $9,800. Okay, all right, so what we're going to do first is record. So this is at the end of the financial year. In most cases, additional information are done at the end of the financial year. So at 31 December, okay, we know that we have received checks for rent, which are 9,800. So when you're receiving checks, it means that you're receiving money in your bank account, and your bank account being an asset account goes up in value, which means you have to debit it. So you would be debiting the cash at bank account by 9,800, but you would be crediting the rent income account by 9,800. So the rent income account is credited, right? So we are preparing the ledger account for rent income, which means the 9,800 has to be recorded on the credit side, and the cross-reference for the relevant account is the cash at bank, okay? So we have got two credits since 1 Jan. So 2,300 plus 9,800 should give us now final balance of 12,100 credit. Okay. Then at 31 December, we also have to include the amount for the actual rent income for the 12 months, which we are going to transfer to the profit and loss account, or the income statement, or the statement of financial performance. Based on the question, the annual rental income was $14,000, okay? So if the annual rental income was $14,000, and we know that all expense and income accounts must be reset to zero balances at the end of the financial year under the accrual basis or the matching concept for an accurate profit calculation. So income accounts by default are credit accounts. When we have an income, we credit it, right? But now that we have to transfer all the amounts out of the income account to make sure that the final balance is always zero, what we have to do is debit it. So we will debit $14,000 in the rent income account with the relevant cross-reference or for the details being the profit and loss or the income statement, okay? Now, what's happening here? So previously we had 12,100 credit. Now we have 14,000 debit, which means we have more debits than credits, right? So we obviously know that the final balance will have a debit. And what's the difference here? 14,000 minus 12,100, which is 1,900, okay? I believe I did the math correctly. Yes, 1,900. Now, we already know that this must have a zero balance at the end of the financial year. So how do we make sure it has a zero balance? Previously, we had a balance of 1,900 debit, which means now we need to have a balance of 1,900 on the credit side so that altogether this gets offset and we are left with a final balance of zero, okay? Now, What can have a credit balance? A liability or an asset? It is an asset. As you can see, based on the table which we have done earlier, all assets have an opening balance on the debit side and a closing balance on the credit side. So if it is an asset, can we call it a rent income received in advance, or should it be rent income receivable? If you got that correct, it's rent income receivable, because that is what falls within the definition of an asset. Because when we say rent income receivable, it means that the tenant has used our space but still hasn't paid us yet. Okay, so there are some economic benefits attached to it which we expect to get from our tenant in the next financial year. So therefore, at 31 December 2016, it's going to be rent income receivable. All right, so on that basis, altogether, the net balance comes out to be 0. Now that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel. And you will see there's a link in the description where you can book a call to discuss your monthly tutoring and coaching requirements to help you prepare for your exams in October and November. So I'll see you in the next video.